Hello and welcome to today's video. Today I will be covering a well-known fintech stock PayPal following their latest earnings, after which market reaction was anything but pretty. I will focus on earnings and their call, and for those who are interested more into their business, you can check my other video, the link should appear above. If you are looking for a solid investment broker, I personally use Interactive Brokers. They have decent platform with great mobile app, stock, ETFs, options are just to name a few optionalities they offer, combined with low fees of course. Use my link in the description of the video, turn up to $1,000 in their stock. Now disclaimer. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. So, first onto the good and mixed things. So, enterprise payments, total payment volume continues to recover. While it has not yet returned to the level seen in the second quarter of 2024, the encouraging part is that this marks the fourth consecutive quarter of growth, suggesting momentum is gradually returning to that segment. Then, PayPal is expanding beyond traditional checkout by embedding its payments directly into leading AI and discovery platforms. The company is forming strategic relationships with players like Microsoft, Perplexity, Google, and OpenAI, aiming to make PayPal a native payment option inside AI-driven shopping experiences. At the same time, it is rolling out Store Sync, a tool that let merchants make their product catalogs discoverable across AI channels while still remaining the merchant of record. With early adopters such as Abercrombie and Fitch, FableX, PacSun, and Wayfair, these initiatives are designed to position PayPal at the center of the next generation AI-powered commerce. Now on to some of their highlights from the earnings. So PayPal delivered steady year-over-year growth across most core metrics in fiscal year of 25, with total payment volume up 7%, revenue up 4%, transaction margin dollars rising 6%, and non-GAAP EPS increasing a strong 14%. While adjusted free cash flow declined 3% to $6.4 billion, the absolute level of cash generation remains significant. Considering the company's accelerating share purchases, the modest drop in free cash flow is not necessarily negative if buybacks are executed at reasonable valuations. They can even enhance per share metrics and long-term shareholder value. Now on their activity and accounts metrics, so they show only modest growth, which helps explain why the market remains cautious. Active accounts and monthly active users increased just 1 to 2% year over year, while total payment transactions declined 4%. For the full year, and transactions per active account fell 5%. At first glance, these aren't the kind of headline growth numbers that typically drive strong multiple expansion. However, the underlying picture looks more constructive when excluding unbranded card processing activity. On PSP front, transaction metrics have been recovering and show consistent growth since Q1 of 2025, with payment transactions excluding PSP up 6% and transactions per active account excluding PSP up 5%. This suggests the core branded ecosystem is stabilizing and improving. Now on to some bad things. So personally, I did not like the decision to replace the CEO, and even less the choice to bring in someone who has already been on the board for the past 5 years. Under the previous CEO, the company was showing visible operational improvements, even if the pace was not fast enough for the market. That criticism is fair, but replacing him with another CEO that was also present during the earlier period when PayPal lost its momentum raises some questions. To be clear, this does not mean the new CEO will do a poor job. In fact, it could turn out to be positive that he is already deeply familiar with the business. Still, if the strategic direction was largely the same, it is reasonable to ask why the previous CEO needed to be replaced. These are the kinds of questions that remain unanswered for now and will be important to watch over the next few quarters. Next reason for the sharp share price reaction appears largely tied to the underwhelming guidance. After a year in which Omni and Venmo posted some of their strongest results, the outlook implies softer transaction margin trends and even a potential EPS decline, despite plans for another $6 billion in share buybacks. That naturally raises questions about what specific investments or cost pressures are expanded to offset these tailwinds, as management did not provide enough detail on the drivers behind the cautious outlook. From an investor's perspective, the guidance can look more like conservative positioning that sets a lower bar for the new CEO, but the market clearly did not reward that approach. Another key development was a clear slowdown in branded checkout, which is still the largest and most important part of PayPal's business. Growth in this segment dropped to just 1% in the fourth quarter, while full-year growth slowed from 6% to 4% year over year. The market tends to focus heavily on this metric because branded checkout historically drives higher margins and stronger customer relationships. As a result, this deceleration likely contributed to negative reaction since it raises concerns about the health of PayPal's core franchise. And now, based on my basic valuation models such as PE, PS and price to operating income ratios, the numbers currently look broken as the stock is trading near absolute all-time lows. That suggests either something inside the business is seriously broken or the market is significantly mispricing the company. Depending on one's own assumptions, these models can be more or less useful, but from my perspective, while it's true that business is far from perfect, the market is pricing it as if bankruptcy is a realistic outcome. From current levels around $41, there is a roughly 80% upside potential, which would imply a minimum price target near $74 per share. And some closing thoughts. So after taking time to fully digest the latest earnings report and market reaction, a few things stand out. I personally did not like the CEO's replacement, as I believe PayPal is much better business today than it was before his arrival 2 years ago. Still, at the scale of the company like this, improvements need to come faster, and deceleration of branded checkout growth to just 1% in Q4 of 2025 fairly raises questions about the long-term health of core business. At the same time, what continues to make PayPal such a force, even with more competition emerging, is its integration with more than 200 partners. That network creates a unique level of global stickiness, and even if none of their future initiatives succeeded, the company could theoretically buy back its entire market capitalization using free cash flow over the next 4 to 5 years, which is quite remarkable. The market is pressuring PayPal for the right reasons, as the long-term trajectory of the core business remains uncertain. However, it is also largely ignoring meaningful improvements in areas like Venmo and omnichannel solutions. If the company manages to execute even one of its growth initiatives, whether in ads or agentic commerce, it could surprise investors. They have missed major opportunities in the past, which justify skepticism, but sometimes it only takes one successful initiative to change the narrative and drive a rating of the stock. As always, I prefer to sandbank my forecast and focus on conservative scenario as my base reference point. Still, it is worth acknowledging that there are also base and bull cases that would justify higher valuation multiples if execution improves. This is it for today's video. If you want to dive on this topic, check Substack. Also, for more daily insights and market updates, check my X account, and for more educational content, check my website. Like, subscribe as a sign of support, and see you in the next video. Bye.